Hey everyone, before we get started today, I want to say something. I've been talking with a lot of you recently, and I can tell. If you've been watching the markets these past few weeks, you're exhausted, right? A war that's been going on for over a month, oil prices swinging every day, the Fed sending mixed signals. Every time you check the news, there's a new thing to worry about. I feel the same way. But while I was putting this video together, one thing became very clear to me. Underneath all the chaos, there is a very specific structure to what's happening right now. And once you understand that structure, the next 6 weeks become a lot easier to navigate. This is going to be a longer one, about 20 minutes, but I'm confident that these 20 minutes will give you the most important framework for your investment decisions over the coming months. So I'd really appreciate it if you stay with me until the end. Let's get into it. Tomorrow morning, the U.S. Department of Labor will release the March jobs report. But here's the thing. Tomorrow is Good Friday. The New York Stock Exchange, the Nasdaq, the bond market, they're all closed. Last month, the American economy lost 92,000 jobs. Wall Street's consensus estimate for March is a gain of 57,000. If that number comes in significantly different from expectations, markets could gap hard when they open on Monday morning. No time to digest over the weekend. But here's the thing. The real problem isn't tomorrow's number. 6 weeks from now, the person who interprets that number, the person who decides whether to raise or lower interest rates, is going to change. In the middle of the worst energy crisis in 50 years. In the 1970s, in an almost identical situation, one judgment call by a Fed chairman dragged the United States into a decade of stagflation. That's the story I want to tell you today. And if you stay until the end, you'll understand exactly what warning history is sending us right now. Let me quickly walk you through where things stand. Most of you probably know the background, so I'll hit the key points and move on. On February 28th, the United States and Israel launched airstrikes on Iran. Iran retaliated by effectively shutting down the Strait of Hormuz. 20% of the world's crude oil flows through that narrow waterway, and it's been virtually blocked for over a month. The result? U.S. gasoline prices went from $2.98 per gallon to $4.06, a 36% increase in 1 month. Diesel is even worse, $5.49 per gallon, up about 46% since the war started. Now, why does diesel matter? Because diesel is what trucks use to deliver goods, what factories run on, what farm equipment burns in the fields. One estimate suggests that a 10% rise in diesel pushes the consumer price index up by about 0.1 percentage points. In other words, when oil goes up, everything goes up. And here's something interesting. The president of the St. Louis Federal Reserve, Alberto Musalem, framed it this way. He said, "This is the fourth supply shock in just 5 years." Let's count them. First, 2020, the COVID pandemic. Factories shut down, supply chains collapsed. Second, 2021 to 2022, the global supply chain crisis. Container shipping rates went up tenfold. Third, 2025, the tariff war. Import costs surged. Fourth, right now, the Iran war and the Hormuz blockade. Every single time the Fed was asked the same question. Is this transitory or is it structural? And every single time, the Fed's answer was the same. It's transitory. We'll look through it. That approach has been mostly right so far. Inflation in 2022 did come back down eventually. But Musalem's warning is this. When something happens 4 times in 5 years, it's no longer transitory. It's becoming the new normal. He said the probability of alternative scenarios, like stagflation, has increased significantly. And the person who makes that judgment call, transitory or structural, is about to change in 6 weeks. Then last night, another variable was added. President Trump addressed the nation and said the war is, in his words, nearing completion. But he didn't give a specific end date. Markets read this as a signal that the war is going to last longer. Right after the speech, Brent crude jumped 5% to over $106 per barrel. S&P 500 futures fell. Nasdaq futures dropped a full percent. Asian markets sold off across the board. So in this environment, what is the Fed supposed to do? Raise rates to fight inflation or cut them to save a weakening job market? Here's the surprising part. Even inside the Fed, they can't agree. Over the past 2 weeks, more than 6 Fed officials have spoken publicly, and their messages are completely different from each other. This is unusual. The Fed is an institution that is extremely careful about speaking with one voice. When its members are publicly contradicting each other like this, it means they can't reach consensus internally. Let's start with the hawks. First, Jeff Schmid, president of the Kansas City Fed. He said the bigger risk is still elevated inflation. There is, in his words, no room for complacency. What concerns Schmid the most is inflation expectations. The University of Michigan's consumer survey showed one-year inflation expectations jumped to 3.8%. When people start believing prices are going to keep rising, they demand higher wages preemptively. Expectations become self-fulfilling. Second, Fed Governor Michael Barron. He said inflation is still around 3% and there's more work to do. Look at the numbers he's pointing to. Core PCE, the Fed's preferred inflation gauge, is at 3.1%. The target is 2%. That's still more than a full percentage point away. And the January monthly reading, when you annualize it, comes close to 5%. That's not deceleration, that's reacceleration. Third, Tom Barkin, president of the Richmond Fed. He's been making the same point for over a year now. Goods prices have come down, but services prices haven't. Let me explain what that means. There are 2 kinds of inflation. Goods inflation covers things like TVs, furniture, cars. That's largely been tamed. The problem is services inflation, haircuts, restaurant meals, insurance premiums. Those remain stubbornly high. The reason is simple. Services are labor-intensive. Wages haven't come down, so services prices aren't coming down either. And now there's an energy shock on top of that. The ISM manufacturing prices paid index surged to 78.3. That tells you raw material costs at the factory level are rising fast. Those costs will eventually be passed through to consumers. It's the textbook definition of cost-push inflation. The hawk's conclusion is clear. If you cut rates now, inflation reignites. Wait at least until core PCE falls below 2.5%. It's a reasonable argument. But the other side has a strong case too. Fed Governor Stephen Moran argued that there's no evidence of a wage price spiral. He says the oil shock should be looked through. His reasoning rests on 2 points. First, wage growth isn't accelerating. Average hourly earnings growth is actually slowing. If we were entering a 1970s-style spiral where wages push prices, which push wages, wages would be moving first. They're not. Second, and this is really fascinating data, even as oil topped $100 a barrel, the market's long-term inflation expectations actually fell to their lowest level in a year. This is a measure called the 5-year forward inflation expectation rate. It's the average annual inflation rate that markets expect from 2031 to 2036. 5 years from now, looking 5 years further out, that number dropped to 2.05%. What does this mean? The market is saying, yes, oil is surging right now, but this is a temporary shock. Over the long run, the Fed will bring inflation back under control. That's an extraordinary vote of confidence. BlackRock's Rick Rieder took this argument even further. He's publicly calling for rate cuts, framing it as insurance. The labor market is collapsing, he says. In February, 92,000 jobs were lost. 3-month average job growth is near zero. Job openings fell to their lowest since 2020. Rieder's logic is this: strip out volatile energy and housing, and the underlying disinflation trend is still intact. If you leave rates where they are while the labor market deteriorates this fast, you'll end up with something much worse: a recession. John Williams, president of the New York Fed, takes a middle position. The oil shock will mainly affect headline inflation, he says. Core inflation is stable. Be patient. And Fed Chair Powell himself laid out his position. There's no urgent need to raise rates in response to the oil shock, he said, but we are watching inflation expectations extremely carefully. That's Powell's strategy: patient observation. And so far, at least it's working. The 2.05% reading on long-term inflation expectations is proof of that. But here's the problem. In 6 weeks, the person executing this strategy changes. And this is where history becomes relevant. We need to talk about the 1970s. This is the heart of today's video, because the structural parallels between what's happening now and what happened 52 years ago are almost uncanny. In October 1973, Arab oil-producing nations imposed an embargo on oil exports to the United States. It was in the aftermath of the Yom Kippur War. Oil prices soared, inflation climbed, but at the same time, the economy was slowing. Unemployment was rising while prices were rising. Sound familiar? The Fed chairman at the time was Arthur Burns. You need to understand this man. History remembers him as the incompetent chairman who let inflation run wild. But the real story is much more complicated. Burns was an economics professor at Columbia University. He was one of the foremost scholars of business cycles in the country. When he took the job, people actually expected him to be an inflation fighter. He hated inflation, but Burns held one fundamental belief. He believed that the inflation of 1973 was caused by rising oil prices. It was a supply problem, not a demand problem. Raising interest rates wouldn't produce more oil. So what was the point? Logically, he wasn't wrong. That is what was happening. But here's where the critical mistake was made. Because Burns judged the oil shock to be transitory, he didn't raise interest rates aggressively. Instead, to prevent a recession, he expanded the money supply. The monetary expansion that began in 1971 continued right through the oil crisis and beyond. The result? Inflation topped 12% by the end of 1974. It seemed to come down briefly, but then it climbed right back up. By 1979, it hit 14%, a decade of stagflation. The economy stagnant, prices surging. The U.S. stock market's real return, adjusted for inflation, was essentially zero for the entire 1970s. For investors, that was a catastrophe. 10 years of holding stocks and your purchasing power didn't increase at all. The man who finally broke the cycle was Paul Volcker. He became Fed chairman in 1979 and raised the federal funds rate all the way to 20%. America went through a brutal recession. Millions lost their jobs. Farms and small businesses went under. But inflation was finally tamed. It took a decade to fix Burns' mistake. So here's the crucial question. Is history repeating itself? CNN recently wrote that the Fed hasn't faced an oil shock this severe since the 1973 Arab-Israeli War. Burns' mistake, in one sentence, he judged the oil shock to be transitory and didn't raise rates enough. And right now, similar language is coming from inside the Fed, the same logical structure. This is a supply-side problem. Raising rates won't fix it. But there are important differences, and we should be fair about them. First, the United States is now the world's largest oil producer. In 1973, America was desperately dependent on Middle Eastern crude. In 2026, U.S. production is 13.6 million barrels per day. The energy import dependency is completely different. Second, the Fed has learned from its mistakes. Powell and the current committee know Burns' story well. Powell's insistence on watching inflation expectations extremely carefully is a direct response to that lesson. Third, and this is the most critical difference, long-term inflation expectations are currently stable. The five-year forward rate sits at 2.05%. In Burns' era, expectations were never anchored. They kept climbing from there. Right now, the anchor is holding. Markets trust the Fed. But there's one more variable. The person managing that anchor is about to change. Kevin Warsh, Stanford undergraduate degree, Harvard Law School, Morgan Stanley, senior economic advisor to the Bush White House. In 2006, at the age of 35, he became the youngest governor in the history of the Federal Reserve. President Trump nominated him as the next Fed chairman on January 30th. His Senate confirmation hearing is expected the week of April 13th. Powell's term expires May 15th. But here's what you need to know about Warsh. There's a contradiction in his record. From 2006 to 2011, during his time as a Fed governor, he was a hawk. When the Fed launched quantitative easing after the 2008 financial crisis, Warsh initially supported it. It was a genuine emergency. But when the crisis passed and the Fed wanted to continue QE, Warsh pushed back hard. When QE2 was approved in 2010, he publicly dissented and then resigned from the Fed shortly after. His argument was this: injecting liquidity during a crisis is correct, but continuing to print money after the crisis is over creates a dangerous dependency. Looking back 15 years later, there's something to that warning. The Fed's balance sheet has grown from about $1 trillion when he joined to roughly $7 trillion today. But then the contradiction emerges. That same hawk recently changed his tune. In a 2025 interview, Warsh said the Fed's hesitancy to cut rates is, in his words, quite a mark against them. So did the hawk become a dove just because he was being considered for the chairmanship? Or did the situation genuinely change? Wall Street is divided. The optimistic view is that Warsh believes an AI-driven productivity revolution can enable growth without inflation. He plans to cut short-term rates while simultaneously shrinking the balance sheet. Open the front door while closing the back door. The critical view comes from economists like Paul Krugman, who pointed out that Warsh warned of soaring inflation in 2010 and was completely wrong. Larry Summers called one of his key papers the single most confused analysis of monetary policy he'd read that year. This is where the ghost of the 1970s reappears. In January 1970, President Richard Nixon appointed Arthur Burns as Fed chairman. At the ceremony, Nixon made a joke. He said, "I respect Arthur Burns's independence." The audience laughed. Burns reportedly grimaced. Nixon pushed Burns to lower rates and stimulate the economy ahead of the 1972 election. Burns didn't tighten enough, and that was one of the key reasons inflation became entrenched. Now look at 2026. President Trump has relentlessly demanded rate cuts from Chairman Powell. When Powell refused, the administration escalated. The Justice Department opened a criminal investigation into Powell over the renovation costs at the Fed's headquarters building. Powell pushed back publicly. He said the threat of criminal charges was directly a result of him refusing to bow to Trump's demands for rate cuts. A sitting Fed chairman directly accusing a president of political retaliation. That is unprecedented in American history. And in the middle of all this, Warsh was nominated. When Trump was asked whether he'd directly asked Warsh to cut rates, the president replied, "That question might be inappropriate, but he certainly wants to cut rates." Republican Senator Tom Tillis drew a line. Protecting the independence of the Federal Reserve from political interference is non-negotiable, he said, and he declared he would block Warsh's confirmation until the investigation into Powell is resolved. So here's the picture. In the worst energy crisis in 50 years, a new chairman nominated under political pressure must lead a publicly divided committee and navigate the tension between demands for rate cuts and the risk of reigniting inflation. The critical difference between the 1970s and now is this. The inflation expectations anchor is still holding. The moment it breaks loose, the real crisis begins. But the person responsible for maintaining that anchor is about to change. If Warsh becomes chairman, he will face 3 structural dilemmas that most news coverage doesn't address, but that investors absolutely need to understand. Dilemma 1. Rate cuts versus balance sheet reduction. Warsh wants to cut rates, but he's also argued for years that the Fed's $7 trillion balance sheet needs to shrink. The problem is that these two goals conflict. Shrinking the balance sheet pulls liquidity out. Long-term rates rise. Mortgage rates, already around 7%, could go even higher. Dilemma 2. Fed independence versus political reality. If Warsh cuts rates as Trump demands, he can't escape the accusation that the Fed's independence has been compromised. But if he refuses Trump, he could face the same kind of pressure Powell did. The Trump administration has already tried to fire sitting Fed Governor Lisa Cook. That case is currently before the Supreme Court. Dilemma 3. What happens when a crisis hits? Every modern Fed chairman has faced a defining crisis early in their tenure. Warsh will be no exception. He's likely to take office while the Iran war is still ongoing. His philosophy is to intervene during a crisis and pull back immediately when it's over. Powell's philosophy is the opposite. Provide support for as long as it takes. If financial stress emerges right after Warsh takes the chair, will he flood the system with liquidity, or will he stand back and let markets correct? The answer to that question could define the market environment for the next decade. Now let's get to the most practical part. What scenarios are possible, and what should you be watching? Let me be clear first. This is not investment advice. I'm giving you a framework for your own judgment. Scenario 1. An orderly transition. I'd put this at about 35% probability. The Iran war winds down. Oil falls back to the $80 range. Warsh is confirmed and largely maintains Powell's cautious approach. The Fed cuts rates once in September. S&P 500 could recover toward previous highs by year-end. Watch for these indicators: daily tanker traffic through the Strait of Hormuz recovering, the outcome of the April 6th deadline, and tomorrow's jobs report, whether it turns positive. Scenario 2. The ghost of Burns. I'd put this at about 40% probability. This is the scenario I consider most likely. The war drags on. Oil bounces between $100 and $120. Warsh takes office, holds rates steady, but then starts cutting under pressure from Trump and growing recession fears. The problem is that core inflation is still above 2.5% when he starts cutting. Cutting before inflation is fully tamed sends a signal that the Fed is prioritizing growth over price stability. That is exactly the mistake Burns made. The most important single number to remember is 2.3%. If the 5-year forward inflation expectation rate crosses that threshold, it means markets are beginning to doubt the Fed's ability to control prices. That is the real turning point. Scenario 3. Political gridlock and a leadership vacuum, about 25% probability. Senator Tillis blocks Warsh's confirmation. Powell remains in the chair past May 15th as a lame duck chairman in an adversarial relationship with the president, making rate decisions during a war. Market uncertainty is maximized. The VIX could remain persistently above 30. Watch for the April 13th hearing date, whether Tillis changes position, and whether a Senate vote is possible before May 15th. Looking at the calendar for the next 6 weeks, there's a critical event almost every single week. Tomorrow, the jobs report. April 6th, the energy deadline. April 13th, the Warsh hearing. April 28th, the Fed meeting. May 15th, Powell's term expires. One more point. For viewers watching from Japan, the Bank of Japan has its policy meeting on April 27th and 28th. Markets are pricing in roughly a 70% chance of a rate hike. If the Fed holds steady while the BOJ raises rates, the yen could strengthen. Anyone who remembers the carry trade unwind of August 2024 understands why that structure is dangerous. If this kind of analysis is helpful, I'd really appreciate a subscribe and a like. And if you turn on notifications, you won't miss deep dives like this going forward. Thank you for watching. I'll see you in the next one.